Bloomberg Audio Studios. Podcasts, radio, news.
Right now, we're going to start strong this 2025. Seth Carpenter manages a heritage at Morgan Stanley. I can't say enough about what Stephen Roach years ago wrought at Morgan Stanley, where he and Richard Berner said, we're not on one page, we're not a marketing exercise, we're going to argue, and it's going to be a constructive, visible argument on domestic and global economics. Seth Carpenter handles that heritage as Morgan Stanley as chief economist. Seth, what's the biggest thing you and your team argue about?
Wow, it's hard to narrow it down, but I think right now it is a question about what should our assumptions be for things like tariff policy and how big of an effect is global trade going to be for the global economy across the world in 2025.
What is the diffusement of technology? Our Ed Ludlow will speak with Jensen Wang from NVIDIA here tomorrow near 11 o'clock. What is the diffusement, as Trichet would say, the diffusement of productivity from technology?
Oh, that's a really critical question. My colleagues, especially in equity research, but across the whole research group here, we've been hyper-focused on AI for quite a long time, I have to say. And translating the micro into the macro is super tricky. So some things that people see as clearly increasing productivity, seeing when that's going to show up in the macro data is a little bit tricky, right? So if you think about my industry, the financial services industry, if a bunch of hedge funds all use large language models and are able to cover a lot more stocks, get more efficient, cover 3, 4, 5 times as many stocks as they had historically, I think everyone would think of that as being more productive. And yet, if they're competing with each other and they can all do it, we might see some of those gains get competed away and they still don't show up in the macro data. So translating the micro AI use cases to the macro data, that for me is a really interesting but super tricky question.
So, Seth, what are you and your team telling your clients about the incoming Trump administration and the economic policies that may accompany this administration? Is there any way to kind of position for that, or is it just too unknown at this point?
A little bit of both. What we've said, usually we do our year ahead forecast, and it's supposed to be a bit of a roadmap for people. But now, this time around, it's more of a set of risks and how to start to create a framework for those risks. So for economic policies that might move the macro needle, we break it down into trade policy, tariffs, immigration policy, fiscal policy, and then deregulation. And what might be slightly controversial is we've said for those last two, fiscal policy and deregulation, maybe move those off the table for 2025 for macro implications. Deregulation, I think, is going to be huge at a micro level, and definitely for individual sectors and parts of the equity market. But in terms of GDP, inflation, that sort of thing, I'm not convinced it matters at all at least for 2025. Similarly, fiscal policy, we're at least for now assuming the Congress spends the better part of the year extending the tax cuts. And so, again, it takes it off the table for 2025. So we're really looking at tariff policy and immigration policy as the key factors here. And so that's part of how we're trying to let people sort of narrow down at least a wide range of possible outcomes. Tariffs are push up inflation and they restrict growth. Immigration restriction would do the same thing. It would restrict growth and push up inflation. The key questions, and this is an area where we say forecast early, but forecast often, are these going to come in one fell swoop? Are they going to get phased in over time, over the whole of 2025, or some combination? I think that's where the irreducible uncertainty is.
Given that backdrop, Seth, what is your call there for 2025 for this Federal Reserve, given some of those policy unknowns, I guess?
Absolutely. So right now what we're saying is the Fed's going to cut again in March and then in June. Chair Powell struck a more cautious tone at the December meeting. We think inflation, though, is coming down in the near term, and so that's going to give them a little bit of momentum to keep cutting rates. But we've assumed that the Trump administration is going to restrict immigration over time. It'll be gradual, so a step down for this year, but not a dropping off the cliff. And similarly, we've assumed a gradual phasing in of tariff policy. And so you don't really start to see the effects of that inflation until maybe midway through the year, and that's why we've assumed two very tentative rate cuts from the Fed, much like what they wrote in their dot plot at the December meeting.
You're deputy director of the Division of Monetary Affairs, which means Seth Carpenter, Dr. Carpenter, folks, had a shingle out front of his door at the Fed where it said, "This is where we readjust the statistics." Are we going to readjust the statistics a lot this year, Seth? Are we going to have jobs reports amended, GDP amended? Is it going to be a year of, oops, we got it wrong?
So I think every year there's a bit of revision. I suspect there is a good chance that we're going to see a bit more of that. I think in the near term, right over the next 3 months, that so-called residual seasonality that we've seen in the PCE inflation numbers, I think that's a real possibility here that could throw a real curveball for the Fed. I will say the numbers on employment, right, given how much immigration we've had over the past couple of years, and as the BLS tries to catch up with sort of their different surveys, I think we could see some more revisions. This year, 2025, is probably the most difficult forecasting year since 2020 and maybe early 2021 when we had COVID. I mean, this is a really tricky year for forecasting.
It's really important, folks. Like, Paul, I've got on non-farm payrolls, 227, a moldy 36, 255, a moldy 78. It looks like a Rorschach test, Dr. Carpenter. And, you got revisions in there as well. What's the real run rate now? Take a 6-month moving average. Be Jason Furman for a moment. He was up at a small college north of Princeton.
Heard of that.
I can't remember. But do a Jason Furman for me right now, Seth Carpenter. And if you got a 3-month, 6-month annualized non-farm payrolls, the answer is it's going to drop down. Is that what I'm hearing?
I think that's right. So we're looking at about 170 or so for Friday's number. Look, the tricky part is immigration has clearly been a big thing. So the monthly run rate that would keep the unemployment rate constant is higher than it was historically. We know the unemployment rate went off of its lows of about 3.5% up to about 4.25%. So the run rate then, or the prints that we've been getting have averaged a little bit less than what that run rate is. And so, maybe we're fallen from the peak of immigration, a run rate of about 250 down to something closer to 200 or 175. We're looking for a roughly stable unemployment rate over the first half of this year because we do think things slow down a little bit, but the immigration inflows also slow down a little bit, so you get a bit of a balancing act there. Super tricky times for economics.
What has been the Morgan Stanley call, your call, about immigration and its impact on the labor market? Because it seems like no matter how many people come in, this economy absorbs them. They get jobs, they start paying their FICA and whatever. How has that really impacted? Do we have a good feel for that over the last several years?
Yeah, I mean, I think there's a lot of uncertainty, but I think a few things are pretty clear. One, there's been a big increase in labor supply from immigration, and that's part of how we were able to get 3% growth or a little bit more in 2023, close to 3% growth again in 2024, and yet inflation kept coming down. So this positive supply shock, I think, is undeniably there. There's got to be a demand component to it as well. And so all of that means part of the strong growth and yet falling inflation is part and parcel to this immigration surge. So a restriction of that, especially if you talk to the folks, for instance, down at Brookings, they would say, really good chance we get net immigration at 0 or even negative this year. That's a huge adverse shock to growth.
Seth, tell us about the dollar dynamics. I've got a 2-day jump condition here and a managed Chinese renminbi. Resilient dollar as well. What is the distinction within 6, 7, 8 pages of foreign exchange analysis on the dollar? What's the paragraph that matters?
I think the paragraph that matters, to come back to one of the uncertainties I was going to say that I was talking about before, is what did tariffs do to the dollar, to currencies, and to global growth? So part of our view has been, the dollar rallied going into the election. There's been some dollar strength. Is that overdone? Well, now we're seeing a little bit maybe more of a hawkish Fed, but I still think the market is wrestling back and forth with what tariffs are we going to see? just the movement overnight and this morning after the news reports in the Washington Post about maybe a narrowing in the scope of some of the tariff policies coming out of the administration. I think that's the real question there is how much do the tariffs slow U.S. growth versus how much do they slow growth in the rest of the world?
Seth, I got to make some news. Has Mr. Percent called you this? Is Mr. Percent Treasury designate? Has he dialed 1-800-Carpenter and said, come on board?
He has not. He has not. I'm always happy to take calls though from any public servant, because after my 20 years in Washington D.C., I think the best thing folks in markets can do is to give an unvarnished, honest opinion of what's going on, so that policymakers can make the best decision.
There you go. I'm sure he's listening. Seth Carpenter, thank you so much. Get out the moving van. Seth Carpenter with Morgan Stanley, their chief economist, and again, public service to the nation with the Federal Reserve and Treasury as well.